So the 16th largest bank by assets was completely destroyed in less than 48 hours. And this is huge for the United States because this is probably the biggest threat to the economy. And as we hear of different news about the 2023-2024 recession, a lot of people are looking at 2008 to see if same things are happening this year. And one of the major downfalls in the last recession was the banking system. And we're now starting to see two banks just completely fail in a matter of a couple of days. So what exactly happened specifically to SVB, Silicon Valley Bank? In today's video, I'm going to explain what happened, what does that mean for you today, and what you should do in order to protect yourself. Now, Silicon Valley Bank, to start off with, was a bank catered towards venture capitalists and tech startup companies. So that was their main niche. And knowing that, their business, their niche, had a ton of money. So most of the deposits in SVB were over $250,000. To be more exact, only 2.7% of all accounts with SVB were less than $250,000. And as some of us know, the FDIC insures up to $250,000 of your deposits. And so you can understand how this bank collapse is causing hysteria in this specific community because most accounts were uninsured. And so essentially what happened with Silicon Valley Bank, to make it super simple in layman's term, was that there was a bank run done on the company, essentially meaning that people were running to this bank in order to withdraw their money, and the bank didn't have enough money to fulfill all of those withdrawals. Why didn't they have that amount of money, and what caused people to actually run to the bank to withdraw their money? Hey, before we go on, please subscribe to this channel. I talk about the economy, I talk about the housing market, so please be sure to support by subscribing. So number one, banks don't hold 100% of your money. They may hold only 10% of your money, and the rest of the 90% of their money, they are investing it in mortgages, they're investing it in bonds and other securities in order for them to make money off of your deposits. And so with Silicon Valley Bank, one of their major assets that they held were in bonds. And bonds are essentially you lending money either to the government or to a corporation. Yes, just like we can go to a bank and borrow money from a bank and they charge us interest and we pay them interest, we can do that with the government. We can actually lend money to the government. Yes, the institution that actually prints money actually is okay with us lending them money, and they're going to pay us interest off of that money. Major banks hold a lot of bonds on their accounts. But the thing that happened with SVB is that they bought majority of their bonds with, number one, super low interest rates before the Fed started hiking up interest rates, which in turn devalues the price of the bond. And on top of that, they were holding bonds with 5-10 years maturity dates on their bonds. And so with that, the price of their bonds fell. And so with the tech industry just experiencing slowdown, some of the hardest hit stocks are in the tech industry, and tech companies laying off their employees and venture capitalists not investing as much in these tech startups. A lot of businesses were taking their money out of banks. And so in order to fulfill those requirements, Silicon Valley Bank had to sell some of their assets in order to cash out and give cash to people coming to their bank to withdraw money. So Silicon Valley Bank, they announced that they lost $1.8 billion in the sale of bonds, and that they were trying to raise $2.25 billion in order to fulfill those withdrawals. And so with those statements, venture capitalists who invested in these tech startup companies that held their money in this bank warned their tech startups, hey, pull your money from this bank because they are asking for capital, because they are selling bonds at a loss. Pull your money from this bank right away. And so this sparked hysteria, and a lot of tech startups went to this bank. There was long lines of people trying to withdraw their money. People were doing it online. And eventually Silicon Valley Bank came to the point where they couldn't fulfill all of those requests. And so regulators had to take control of the company. Essentially, they lost all their money to giving it out to people who left money in the bank. So this was an extremely fast failure of a bank that held its own for about 40 years. A bank with billions and billions of dollars of assets was completely gone in less than 48 hours. And so by the end of last Thursday night, $42 billion were withdrawn from people's account. And so this is the second largest bank failure in US history. Now with Silvergate Capital, it was a much smaller bank, but it was a similar situation with the whole debacle and bankruptcy of FTX. A lot of people withdrew their money from Silvergate Capital because they knew Silvergate Capital was a major investor of FTX. And so once again, that caused them to not be able to fulfill all of those withdrawal requests, which made them cash insolvent, and regulators took over that specific company. And that company was more geared towards the crypto area, right? They did do some tech startups, some venture capitalist funds and things of that nature, but it was mostly crypto. And so SVB was definitely the largest one out of the two because of the amount of assets they held. So there are different options that can happen in order for different depositors to get all of their money back. Most people do predict that most people will get all of their money back, even for accounts over $250,000. And so a lot of people are saying that major banks like JP Morgan Chase, Bank of America, Citigroup can buy out this company in order to fulfill all of those requests. Another option is for the FDIC, the Treasury, and the Federal Reserve to come together and create funds in order to fulfill all of those withdrawals also. Now, the Treasury has made it clear that they are not looking to bail out this company at all. There are other options that they can do in order to save the money or help people get all of their money back, but they are not looking to start a bailout because they know that this may start a ripple effect for other companies coming to the government for a bailout. And a lot of people are saying that this is going to start contagion, that what happened with SVB is going to happen to other even larger banks and just start the financial crisis that a lot of people are predicting to happen. Now, that may or may not be the case because this bank was more geared towards the tech industry, and so is very polarized, it's very in their niche. And bigger banks like Bank of America, Chase, and Citigroup, they're so diverse, right? Most of their monies are not in bonds, right? They have MBS, mortgage-backed securities. They have a ton of cash. They have other investments that they can lean upon if one of their investments goes down. So what does that mean for you? Well, one thing that it means is that the Fed may not hike the interest rates as high as a lot of people thought they would in order to slow down the contagion, because a lot of banks have bought bonds when interest rates were low. And so in order for banks not to experience something similar when interest rates go up and the price of their bonds go down, the Fed is probably not going to hike up interest rates as much. You, as a person who may not have over $250,000 in your bank, number one, nothing of this will affect you. Just like in '08, if you held less than $250,000 in your bank account with any bank, you didn't really run into any serious issue, right? If you work for these tech startup companies, yes, you may have an issue with them not being able to fulfill payroll because right now they don't have all of their funds in order to pay all their employees. That's one issue. But for regular retail consumers with less than $250,000 in the bank, and let's say most of your net worth is in stocks or most of them are in properties, you should be fine. And this may even flatten out mortgage rates, which increases the demand for housing and actually keeps home prices elevated, right? And so it's a two-edged sword because on one end, the Fed actually wants to continue raising interest rates to cool down inflation, but on the other end, they want to lower the Fed rate in order for banks to be safe if they want to sell their bonds at a specific price so it won't be a huge loss. And so regulators are trying to find a way to solve both problems. But is this going to start contagion in this industry? I'm not sure. I know a lot of people said that when they were comparing the recession, a lot of people said that in '08, people were just saying, oh, these are just banks mostly dealing with real estate, right? Banks that were heavily invested in mortgage-backed securities, not like bigger banks, but the contagion happened to spread to all banks in America. And so is that what's going to happen this time around? Oh no, this is only going to be experienced with tech companies, sort of banks, or banks that are catered to this industry, and then eventually is going to spread to other banks? Or is it just an isolated event to a specific industry? We do not know, but hopefully this explains exactly what happened with SVB, because I know a lot of people are trying to understand, what does this mean? Bonds, securities, they couldn't do this or that. They were trying to raise capital, and hopefully this video explained it simply for you all. Make sure you all subscribe to this channel for some more content on the housing market, on the economy as a whole, and be sure to like and comment down below your thoughts on this financial crisis.